Hello everyone, how are you? I hope all of you are doing really good. Welcome to Economics of Finance Excellency batch. Okay, so before we start with our new chapter that we are going to start in this video, one thing is pretty sure guys, ICAI has confirmed for the November 23 attempt that this is the same course that is going to continue for you. So these lectures are applicable for May 23. These lectures are applicable for May 23. These are applicable for November 23 and onwards. And onward means in case the new course doesn't come in May 24, these will be applicable for May 24 also. Sir, in case there are amendments, then what will happen? In case there are amendments, I am here to cover it. So nothing to worry as about. Okay? So this is the applicability as of now till the new course is applicable, because in the new course this EFF is not is not there. It has been removed and all these topics are going to be shifted to the CA foundation part. So in the intermediate this EFF is not going to be there. So even the November 23 students, all those who want to prepare for both the groups in November 23 guys, you can go for these lectures, you can go for these books, right? Sir, where to buy the books from? You can buy the books from our website. The link is on your screen only, right? www.ksjteaching.org, and it is in the description of the video also, right? And follow us on Instagram also. Let's grow this family on Instagram also. Okay. So now we are done with our chapter number 3. We are moving on to chapter number 4, that is market failure. Again, a very important topic. So some students asking me that, sir, what kind of theory questions are asked? Sir, theory questions, whatever we are studying here, all these topics you have to go through thoroughly from the book. Like theory question can be on this stabilization function, explain the stabilization function in short, 3 marks question, right? It can be from the national income, any question from the national income. What are from the Keynesian theory can be there. What are the leakages? What are the injections, right? How the treatment of transfer payments is being done. So all these things are what? All these are theory questions only, which can be asked in the examination. Okay. For 2 marks, 3 marks, normally the theory questions are being asked for 2 to 3 marks and the practical for 5 marks. Okay. How to remember it? For remembrance, what you have to do is go through these topics again and again. Whatever we are discussing, whatever this explanation is, you have to go through the topics, right? If you have these books, then it is the best version. You will be able to remember the things easily. Or if you want to follow the ICAI module in the paragraph form, that is totally your choice. Okay. Okay, so we are going to start with our next chapter, chapter number 4, that is market failure. Now, what is this market failure? Try to understand this market failure, sir. Our next chapter, chapter number 4, market failure. So, in the last lecture or in the last chapter of fiscal functions, we discussed about what? We discussed about the efficient allocation of resources. Efficient allocation of resources. Now we say the efficient allocation of resources. When is this efficient allocation of resources is there? When we say that demand is equal to supply. Is equal to, right? What is being demanded? That is being supplied. Then we can say that the resources are being efficiently allocated and being used. But in reality, do you think the efficient allocation of resources is there? No, sir. For that, what is the requirement? What is the requirement is government intervention. Government intervention in the form of allocation function, redistribution function, and stabilization function as discussed in the last lecture. Now, what will happen? What will happen if there is inefficient allocation of resources? If there is inefficient allocation of resources, then what will happen, sir? Sir, it will lead to demand being not equal to supply, right? The reason is that demand is not equal to supply. If there is inefficient allocation of resources, that means that our demand is not equal to supply. And when the demand is not equal to supply, this situation, Either demand is more than supply or supply is more than demand. This situation is known as market failure, right? So what is market basically? When we are talking about this word market, that means we are talking about two things. One is the demand in the market. Another thing is supply in the market. So the whole game revolves around this demand and supply. Market failure means that demand is not equal to supply. Either the demand is more than supply or either the supply is more than demand. Let's see now. So market failure, what is the concept of market failure? We say the market forces of demand and supply are generally believed to be amazingly competent and capable of achieving optimal allocation of resources. We say normally what we believe is that demand and supply will automatically adjust, right? That what is being demanded, that will be supplied only. It will automatically adjust, leading to the efficient allocation of resources. But in reality, what we believe is something different, but in reality, it can be something different. But in reality, the markets fail to allocate the resources efficiently, resulting in the market failures, right? In reality, the demand will not be equal to supply. And when the demand is not equal to supply, we say that the resources are not being efficiently utilized. Only then the demand is not equal to supply, or due to demand not being equal to supply, the resources are not being used efficiently. Market failure is a situation in which the free markets, that is the demand and supply. Free markets are what? The free markets are the market where the demand and supply are only working, right? There is no government intervention, nothing. Those are the free markets. Leads to the misallocation of the society's scarce resources. Understood? There is either overproduction or underproduction of particular goods and services, leading to less than optimal outcome. So he says what will be the result of this demand being not equal to supply? He says either there will be overproduction of goods, either there will be overproduction of goods and services. That means whatever is not being demanded, even that is being produced. Right? Whatever is not being demanded, even that is available in the market. Why it is available in the market? Because it is being produced, or it is being underproduction of goods and services. Now, this situation, if you talk about the overproduction of goods and services, what is the situation? Sir, here the supply is more than demand. Here the supply is more than demand. So you are not demanding a product, but the product is available in the market, right? That is what? Overproduction. Then what will happen in case of underproduction? So demand is more than supply in case of underproduction. So a product is being demanded, but it is not available in the market. So what will happen? In that case, your demand is more than what is being supplied. Right, sir? Clear? So that is what is overproduction and underproduction of particular goods. In simple words, market failure exists when either the demand is more than supply or the supply is more than demand. That is what I have explained it to you, right? So you can prepare it in this flowchart form also. That's totally fine, right? If you want to make your own short notes for the later on understanding, you can prepare these kind of, the short notes with the flowchart kind. Okay. Now, what are the aspects of the market failure? The aspects are, the market failure can be a demand side market failure, right? Or the supply side market failure. Now, what is a demand side market failure? The demand side market failure means when the demand is more than supply. When the demand is more than supply. And what is a supply side market failure? It is when the supply is more than demand. When the supply is more than what is being demanded. Sir, let's see what is there. The demand side market failure occurs when the demand curves do not take into account the full willingness of the consumers to pay for a product. Sir, how is it possible? Let's see with the help of an example. He says the clean air does not involve a price, but it is required, right? because it can be obtained without paying for, but is a basic demand of any consumer. Now, what is he saying, sir? He says that you need clean air. You need clean air. Obviously, for the survival, everybody needs a clean air. Isn't it? For your survival purposes, you need a clean air. Is there a price for that? No, sir. No price attached to it. Now, you are a manufacturer. You are a manufacturer, right? And obviously, during the manufacturing process, there will be some waste and all those things that will go into the environment, isn't it? Now, this clean air is what? This is the demand. This is the demand of people. Demand of people. Clean air is the demand of people because it is the basic necessity for survival, right? Is it being considered by a manufacturer? Is any manufacturer manufacturing this clean air, or is he considering this particular factor that clean air is being demanded by the society, by the people? Will he be, or he or she be providing this clean air? No, sir. Right? No manufacturing, no consideration, no manufacturing, no consideration, and ultimately, what will happen? No supply. Now, what happens, sir? Here, the demand is more than supply. Demand of clean air. Demand of clean air is more than the supply of clean air. Supply of clean air. Clear? The demand of clean air is more than the supply of clean air. Understood, sir. No business will consider such demands by the consumers, leading to imbalance between demand and supply. Obviously, some of the things are the hidden demands which are not considered by the businessman, and as such, they get ignored, right? They get ignored, and in the process, there is the imbalance is created between demand and supply. Now, the next is the supply side market failure. Now, what is a supply side market failure? Supply side market failures occur when the supply curves do not incorporate the full cost of producing the product. He says that whatever the supply is being done, they are not considering the full cost of manufacturing the product, sir. That means the business is going into the losses, right? As a layman, we may say, because we have been studying about the cost accounting also. So we may say that, sir, if the businessman is not taking the full cost of manufacturing of the product, then that means he is doing the business in losses, right? No. Now, what does this mean by that? They do not incorporate the full cost of producing the product. Example, a manufacturing unit discharges the waste into a nearby river, polluting it. Now, the people using that river water will have to bear the cost in terms of bad health. No business will consider this cost. Try to understand. Very simple way. In the similar way, I have explained clean air to you. I'll try to explain it, right? What is there? So, there is a wastage. There is a wastage that is going into the river, right, sir? There is a wastage that is going into the river. Now, it is being supplied by businessman, supplied by businesses, right? Is it demanded by people? Is it demanded by people? Sir, is it demanded by people? No, sir. It is not being demanded by the people. Now, what happened? Here, the supply is more than demand. Supply is more than demand. Again, creating an imbalance between the demand and supply. And this thing we say that the supply side market failures occur when the supply is being done, but the whole cost of this supply is not being considered, right? That the people have to bear some extra cost due to this supply. Right? Obviously, if the businessman is, that particular manufacturing unit is discharging the bad water, the waste into the nearby river, and the people using it, they are obviously going to get ill using that water, right? So that is not being considered by the business. So that is not a demand for the people. That is not a demand for the people, but it is being supplied. So supply is more than demand in this case. So basically, these are the two things, the aspects of the market failure, that is the demand side market failure and the supply side market failure. The demand side is when demand is more than supply, and the supply side is when supply is more than demand. Next is, what are the various reasons for the market failure? We need to understand that if the market failure is there, what are the various reasons of that market failure? Why there is a market failure? The major reasons are, four major reasons are there. One is the market power. Another one is the externalities, very, very important. Then is the public goods, then is the incomplete information. So these four major areas we have to cover. Let's start with the first segment, the first reason for the market failure, that is market power. What is the meaning? He says the market power or the monopoly power is the ability of the firm to profitably raise the market price of the goods and services over its marginal cost. Now, what will happen if you have the market power? Market power here means that you are enjoying the monopoly in the market. You are the only major player of that product in the market. Now, what will happen? Sir, you are in a position to charge any price from your customer, whatever you want to have, right? What will happen, sir? If your product is having very high charges, then there is quite a possibility of a scenario where you will have the goods, but the people will not have the money to buy your goods. In that case, the supply will be more than what is being demanded, because everybody can't buy those costly goods. For example, KSJ Limited is a sole manufacturer of special jackets in Kashmir. Now, since KSJ has the monopoly, that means there is no competition in the market. It can charge any price from its customers. This is called market power. Now, how the market power will create the market failure? We need to understand this. I've just given you one aspect of it, that with the market power, you can charge any prices from your customer, and there can be a time when the customers are not ready, not willing to pay for the product that you are manufacturing because you are charging so high prices. The customer might not be in a position to demand that product. So in that case, your supply will be more than your demand. Clear? Now let's see how the market failure creates, how this market power creates a market failure. It says high prices. The firms with the market power are the price makers. That is, they can charge any price which helps them in generating the positive economic profits, that is over and above the normal profits. Very high prices, sir. And in the case of very high prices, the demand will obviously fall, where leading to what will happen with the high prices, that the demand will be less. Demand will come down, obviously, because everybody can't afford those high prices. Then what will happen, sir? This will lead to supply being more than demand. Supply being more than demand. Clear? The next is lower output. Lower output means a single producer monopoly will always have the limitation with regard to the number of units it can produce. So it might not be able to fulfill the quantities demanded by the customers, thus creating an imbalance between. Now, what will happen? Let's say you are the sole manufacturer of the jackets, right? And in a particular area where there is there's too much cold, right? You are the sole manufacturer. Now, can you manufacture this much quantity that you are able to meet the demand of each and everyone in that area? Sir, it is very much difficult. If you are only manufacturer, right, with a special kind of a fur or with a special kind of a material that is required to contain that cold, right? I think that is not possible, right? Every output, every kind of a product you cannot manufacture. So in this case, lower output, what will happen? Sir, demand will be more than supply. Demand will be more than supply. Sir, you cannot manufacture every kind of a product that is being demanded in the market, because obviously you will have the limitation in terms of the capacity of the plant, in terms of what you can manufacture in a particular period. Then the non-existent markets. What are the non-existent market? There may be a failure to produce the certain goods, even if such goods or the services are wanted by the people and socially desirable. As I told you, that what the businessman is mainly focused on. The businessman is mainly focused on earning the profits. So in the process, in the process, let's say I want to have a particular good which is very socially also desirable, right? Which is socially also desirable, which is required by the people, but it is not being manufactured by anyone, right? It is not being manufactured by anyone. So what will happen, sir? In that case, again, your demand will be more than supply. Sir, why there will be these things happen? Because the businessman, let's say any product, I'm not getting in mind what product it can be. Pure public goods we will study later on. Sir, any product, right? Businessman is manufacturing a product which everyone is not using, right? Which is only for the rich people, right? There is concentration of wealth. If the concentration of wealth in the very few people, and that particular person is, let's say, manufacturing the aeroplanes or helicopters, right? A particular manufacturer is manufacturing the helicopters and he is the sole manufacturer of helicopters. Then what will happen? Will you or I be able to buy that helicopter? No, sir. What we are demanding is the basic things, the food, cloth. We are demanding that, and he is not ready to manufacture that. Then what will happen, sir? The demand will be more than the supply. Helicopters, who will buy the helicopters? Only the very, very, very rich people, extremely rich people can buy the helicopters. They will be buying, but we cannot buy it, isn't it? Can we buy it? No, sir, we cannot buy it. So this is the non-existent market. Whatever we are demanding, there is no market for that because of no competition, less number of manufacturers, right? Or the sole manufacturer is there. For example, pure public goods we will discuss later on. We have a full topic on the pure public goods, right? So this was the first reason for the market failure, that is the market power. The second reason is very, very important, that is externalities. Now, what is that externality? We will just discuss little bit about the externalities, then go into the details in the next lecture. Meaning, when the actions of either the consumers or the producers result in the cost or benefit that do not reflect as a part of the market price, such cost or benefits are called the externalities. Now, let's say what is an externality? Try to understand. When he says the action of either the consumer or producer result in the cost or the benefit to another person that is not being considered in the market price of the product. That means whatever the price that is being charged for a product, that cost or benefit that is not considered. Here also we have taken an example. One example we just took, that is this part, discharges the waste. There is a businessman, there is a manufacturer, right? There is a manufacturing unit. That manufacturing unit is discharging the waste into the river that is being used by the people who are living by the river side, right? Into the same river, the people where the people are residing the river side, and obviously those people are using the river water. Now, what is happening here? There is an action of a producer, right? What is the action of the producer? What is the action of the producer? Action of the producer here is discharge of the waste. This is the action of the producer, discharge of waste. Now we say when the people will get ill, there will be a cost to this. If you are discharging the waste into the nearby river and the people are using that water, people are getting ill by using that water. So that is a cost to it. Is it considered in the market price? Is this cost considered in the market price? No, sir. Now this is the cost to consumer, right? So this is what an externality, right? This is known as externality. When the action of one, either the producer or the consumer, has an impact, impact can be in the terms of cost also, impact can be in the terms of benefit also, which is not reflected in the part of market price. Such cost or benefits are the externalities, right? Sir, what can be the benefit? Sir, we have understood about the cost. Then what can be the benefit? Try to understand. The same producer who is discharging the waste, he helps in cleaning that particular river, right? There is a producer, he is discharging the waste into the river, then he employs some person to clean that river. Now what is that? Sir, this is his personal initiative. This is his personal initiative. So this becomes the action now. This becomes the cost to the producer, but benefit to, this is what? This is benefit to consumer, right? This is benefit to consumer. This is again an externality. This is again an externality, that the external factors are there. Let's say, let's take a very simple example. You take a garbage bag from your home and you throw the garbage, in front of your neighbor. Why? Because you are not happy with your neighbor, right? Because you are having the fights every day. So you, what you are doing is taking the garbage bag from your home, throwing it in front of, the home of your neighbor. Then what is that? That is an externality. The action of you having an impact on the action of your neighbor, because then the neighbor is a very, the sober person. He says, it's okay. That is, you are a mental case, whatever. He calls a sweeper. He asks the sweeper to take away all this garbage. Now he is paying for that picking up of that garbage, isn't it? So that is what? That is an externality, that the action of one person is having an impact in the terms of cost or the benefit. That is known as externality. An externality occurs when a consumption or the production activity has an indirect effect on the others' consumption or the production activities, and such effects are not reflected directly in the market price. There is no market price for that, right? There is an indirect impact. Is there any market price for this cleaning the river? No, sir. That is the personal initiative. Is there any market price for this discharge of waste and the cost that the people have to incur because of that? The people will go to the doctor. Those are already the poor people. They will go to the doctors. They will pay the fees, and all that is what? The cost, which is not considered in the market price of the product, right? So what are the features? The features are the originator. Originator means who is the action creator of the externality imposes the cost or benefit on the other person, which are not responsible for initiating the effect. Right? The originator means the initiator of the action, who is doing that action, whether it is a producer or whether it is a consumer. If he or she is taking that action, right, which is resulting in the cost and benefit to the other person without being responsible for that. It occurs outside the price mechanism. That means not through the operation of price system. That means it is not being considered in the market price. It is initiated and experienced outside or external to the market. Obviously, what is being market? The market is the normal demand and supply of the goods. These things are operating outside the market. That is why they are not considered in the market price, right? These externalities are being done outside the market, outside the normal demand and supply of the product's condition. It is uninternalized, that is, the cost or the benefit thereof is not borne or paid by the parties concerned, right? Now this cost, who is paying this cost? Sir, in this particular case, who is bearing the cost? Sir, the people who are living the river side, they are paying the cost. Is the producer paying the cost? No, sir. He is not paying the cost. That is why it is known as uninternalized. That is, the cost or benefit is not borne by the parties concerned. Those who are imposing that cost or the benefit, because of whom that cost or benefit is being incurred, they are not taking the responsibility of that. It is also called the spillover effect, neighborhood effect, third party effect, or the side effect. So all these are the names of the externalities which you should remember, because institute can ask you anything by these names also. Right? Spillover effect, neighborhood effect, third party effect, or the side effect. Right, sir? Now, very important topic that we'll be starting in the next lecture, that is the types of externalities: unilateral, reciprocal, then positive and negative externalities. This is very, very important. Very important part. The most important part is this part, right? Then we'll move on to private cost, what is social cost, impact of externalities. All these things we will be studying, right? So we'll continue from the externalities in the next lecture. I hope all of you enjoyed this series. And if you are enjoying this series, guys, please share with all your friends. That is very, very important, because We all are a family, right? And for the growth of family, everyone has to contribute. So that is a minimal contribution that we are asking from you, that please like the video, share with all your friends, and most importantly, as I told at the very beginning, that these videos are for November 23 attempt also. And moreover, if the new course doesn't come in May 24, these videos will be applicable for May 24 also. In case of any amendments, we are here to update that, right? But you need the books, because with the books, it will be very easy for you to understand each and everything, right? So we'll continue in the next lecture from externalities. See you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.